In this video, we will be completing the journal entries related to standard costs. There are 3 journal entries to complete for standard costing, one for each product cost. So that makes one journal entry for direct materials used, one for direct labor used, and one for factory overhead applied. The standard costing journal entries are a modification of the journal entries to work in process that we discussed in the job order costing video. The template for the journal entries for adding direct materials, direct labor, and factory overhead to jobs that we used previously are showing on the screen now, which each include a debit to work in process inventory. We will modify these journal entries to incorporate standard costs. Specifically, we want to somehow incorporate the idea of favorable and unfavorable variances from standard cost into these journal entries. First, let's look at the direct materials journal entry. Here's the table we created in a previous video when we calculated the direct materials variances. The only numbers we need are the actual cost, the standard cost, and the price and quantity variances, so I'll just move them to the side of the screen. Just like in the job order costing video, when adding direct materials to a job, we must debit work in process inventory and credit raw materials inventory. But the difference is we debit work in process for the standard cost and credit raw materials for the actual cost. That makes for a $14,580 debit to work in process and a $14,000 credit to raw materials inventory. Now, I left some space here because the journal entry doesn't balance. The difference between these two values needs to be made up of the 2 direct material variances, the price and quantity variances. The quantity variance is $420 unfavorable. Unfavorable variances translate into debits in the journal entry, so we debit an account called direct materials quantity variance for $420. The price variance is $1,000 favorable. Favorable variances translate into credits in the journal entry, so we can credit an account called direct materials price variance for $1,000. As long as the amounts are immaterial, meaning the amounts are insignificant enough not to influence external user decisions, the variance accounts are closed to cost of goods sold at the end of the period. Now, this journal entry is sometimes broken into 2 separate journal entries. The price variance really should be recorded at the point of purchase, and the quantity variance should be recorded when the materials are used, and the materials might not be purchased and used on the same day. Split up, the 2 journal entries look like this. For the purchase, we credit accounts payable for the actual cost we paid. We debit or credit the price variance depending on if it was favorable or unfavorable, and we debit raw materials inventory. The raw materials inventory can be found by balancing the journal entry, or it is also AQ times SP from the standard cost worksheet we referenced earlier. The second journal entry is for the use of materials. We credit raw materials inventory for whatever it was debited for in the purchase entry, debit or credit the quantity variance depending on if it was favorable or unfavorable, and debit work in process for the standard cost. Next, we can move on to the direct labor variance journal entry, which is very similar. Here we have the table we created in a previous video when we calculated the direct labor variances. The only numbers we need are the actual cost, the standard cost, and the rate and efficiency variances, so I'll just move them to the side of the screen. The journal entry you may be used to for adding direct labor to jobs is a debit to work in process and a credit to factory wages payable. We debit work in process at the standard cost of $16,200 and credit factory wages payable for the actual cost of $17,600. The labor rate variance is $1,100 unfavorable, which translates into a debit of $1,100 to the direct labor rate variance account. The labor efficiency variance is $300 unfavorable, which translates into a $300 debit to the direct labor efficiency variance account. Finally, we have the factory overhead variance journal entry. You may remember that there are separate variances for variable and fixed overhead, but we include both variances in one journal entry. So we'll need to grab some information from both the variable and fixed overhead tables that we created in a previous video. Here we see the variable overhead table. We need the actual variable overhead, the applied variable overhead, and the spending and efficiency variances, so we'll move those to the side. Here's the table that we made for the fixed overhead variances. We need the actual fixed overhead, the applied fixed overhead, as well as the spending and volume variances, which we will list along with our variable overhead values. The entry you may be familiar with for applying overhead to jobs is a debit to work in process and a credit to factory overhead. The debit to work in process is for the applied overhead, to which we must add the applied variable and applied fixed overhead together. 2,160 plus 1,080 equals $3,240. The credit to factory overhead is the actual total overhead incurred, which is equal to 2,100 actual variable overhead plus 1,260 actual fixed overhead, which is equal to $3,360. Then we have the three variances to fill in the middle. Let's start with the variable overhead efficiency variance of $40, which is a debit in the journal entry since it's unfavorable. Then we have the volume variance, which is equal to $180 unfavorable, making it a debit in the journal entry as well. The spending variance is made up of a variable and a fixed component. The variable spending variance becomes a $100 credit in the journal entry since it's favorable. We don't need to include the fixed spending variance in the journal entry since it's $0, but if we did have a fixed spending variance, we would need to include it as a separate line in the journal entry. Okay, that wraps up the journal entries for standard costing.